What happened last night is genuinely historic in the context of 2026 financial markets. The US and Iran agreed to a 2-week ceasefire, including the reopening of the Strait of Hormuz. Benchmark US crude sank $18.43 to $94.52 a barrel, a nearly 16% decline. This was the largest single-day oil price drop in years. S&P 500 futures jumped to 0.7%. Dow futures climbed to 0.6%. Nasdaq futures soared 3.4%. Washington Times. Asian markets surged dramatically. South Korea's Kospi surged almost 7%. Japan's Nikkei advanced almost 5%. European markets advanced almost 4%, with Germany's DAX leading at 4.8% gains. Airline and travel stocks jumped 10% or more as energy costs plunged, CNBC. This is the single most significant positive financial event since the Iran war began 5 weeks ago. The fear that had been building oil at $111, inflation at 4.2%, recession odds elevated. The Dow in correction, all of those pressures just got partially reversed overnight. And yet Warren Buffett, 95 years old, the most successful investor of all time, sitting on $350 billion in cash, is still not buying. In the next 14 minutes, I am going to tell you why. What the ceasefire actually means and does not mean for the economy. What the data says about the next 30 to 90 days. And the 7 specific moves to make right now. In the aftermath of today's extraordinary events. Let me start with clarity on what actually happened last night, because the headlines are doing a poor job of distinguishing between what is real and what is uncertain. What is real? The US and Iran agreed to a 2-week suspension of hostilities. The Strait of Hormuz is reopening for shipping transit. Oil prices fell dramatically. Global stocks surged. The immediate financial pressure from the energy shock is relieved for now. What is not yet real? The ceasefire is not a peace agreement. Iran's 10-point proposal reportedly includes the withdrawal of US combat forces, lifting of sanctions, and continued Iranian control. Formal talks are expected to begin in Islamabad. The wide gap between the two sides' stated positions and conflicting signals over ceasefire in Lebanon serve as sober reminders that the next 14 days will be anything but straightforward. Economists are warning the economy does not just snap back. Damage to infrastructure, higher shipping and insurance costs, and structural shifts in energy pricing mean the shock will likely have a long tail feeding through to inflation, growth, and corporate earnings over the coming months. Newsweek. Even the reopening of the Strait of Hormuz, subject to Iran's technical limitations, will take weeks if not months before shipping backlogs are cleared and supply chains normalize. Crude oil prices are therefore unlikely to revert to pre-war levels in the near term. The world's largest liquefied natural gas export complex had 17% of Qatar's export capacity knocked offline. Repairs expected to take 3 to 5 years. The bottom line in plain language: today's rally is real and deserved. The underlying economic damage from 5 weeks of oil shock is also real, and does not disappear with a ceasefire announcement. Both things are true simultaneously, and anyone who treats today's surge as a permanent all clear is making the same mistake that people who treated each fear headline as permanent made over the past 5 weeks. Let me walk through exactly what happens to your specific financial life over the next 30 to 90 days if the ceasefire holds. Days 1 to 14, the ceasefire window. Oil stays around $90 to $95. Lower than the $111 peak but still above the pre-war $70 level. Gas prices begin declining from $4.11. You should see prices moving toward $3.70 to $3.90 by early May. If the ceasefire holds, your 401k benefits from the market rally but remains below January highs. Inflation expectations moderate, which gives the Federal Reserve more room to consider rate cuts later in the year. Days 15 to 30, the critical window. The ceasefire either extends into formal peace negotiations or expires. If negotiations are progressing, markets continue to recover. If the ceasefire collapses, oil spikes again, markets fall, and all the economic pressure returns. This is the most important variable for your financial situation in May. Days 30 to 90 if ceasefire becomes permanent peace. Oil gradually returns toward $80 to $85. Gas prices fall toward 3.20 to 3.50. Inflation moderates meaningfully. The Fed gets room to cut rates. Mortgage rates begin falling. The stock market recovers toward all-time highs over the following 6 to 9 months. Your 401k fully recovers and moves higher. Days 30 to 90 if ceasefire collapses. Oil spikes back above $110 within days. Markets fall sharply. Recession odds spike. The economic damage is worse than before because businesses and consumers had started to relax. This is the scenario Buffett is hedging against with his $350 billion cash position. Both scenarios are genuinely possible. Anyone who tells you they know which one is coming is lying to you. What you can control is being positioned to benefit from the positive scenario while being protected enough to survive the negative one. This section is the most important one for calibrating your emotional response to today's euphoria. Buffett sees the dip but does not think the market pullback is deep enough to take advantage of. And that is even more true following the stock market surge on the ceasefire announcement. Despite the pullback, the market is still expensive by historical standards, and Buffett knows that. A steeper sell-off seems likely at some point given the market's current valuation. The motley fool. The Shiller-Cape ratio is at 39.7, the second highest valuation reading in 150 years. A 10% correction from that starting level does not make the market cheap. It makes it slightly less expensive. Buffett's standard is not slightly less expensive. His standard is genuinely cheap. And the market is not there yet. Here is the deeper principle Buffett is operating on. He has seen this movie before. Many times. A major crisis creates a massive market drop. A resolution ceasefire, bailout, vaccine creates a massive one-day surge. The crowd interprets the surge as the all-clear. They pile in. And then the secondary effects of the original crisis work through the economy over the following months, slowing earnings, rising costs, tightening credit, and the market pulls back again. This is the classic relief rally trap. The first day is real. The follow-through is not always guaranteed. Buffett is not saying do not invest. He is saying do not mistake a relief rally for a fundamental shift in value. He is waiting for the market to be genuinely cheap, not just cheaper than its peak. And he is in no rush because his $350 billion cash position means he can be patient in a way that generates a real return while he waits. What does this mean for you specifically? You are not Buffett. You do not have $350 billion. And you do not need to wait for the perfect entry point to build long-term wealth. Your tool is consistent monthly investment into broad index funds regardless of market levels. That consistency, not perfect timing, is what builds the vast majority of ordinary investors' long-term wealth. But Buffett's caution should temper your enthusiasm about interpreting today as a permanent turning point. Remain invested. Keep contributing. But do not dramatically increase risk or leverage in response to a single day's rally. Driven by a 2-week ceasefire. Let me give you the historical context on what typically happens after the kind of single-day surge we saw today. The average one-day surge of 2.5% or more in the S&P 500 following a geopolitical resolution has historically been followed by one of three patterns. Pattern 1, the extended rally. The geopolitical resolution is genuine and lasting. Underlying economic conditions were strong enough to support higher prices. Markets continue higher over the following months. This happened after the Liberation Day pause in April 2025. The market surged and kept going higher for months. Pattern 2, the consolidation. The resolution is real, but economic damage takes time to work through. Markets level off after the initial surge, trading in a range for several weeks while data catches up, then they gradually trend higher as macro damage heals. This is likely for the next 4 to 6 weeks. Pattern 3, the relief rally trap. The resolution proves temporary or incomplete. Secondary economic effects bite harder than expected. Markets give back the initial surge. The ceasefire collapses. Oil spikes again. The fear returns. The honest assessment is we are most likely in pattern 2, with a meaningful risk of pattern 3 if the ceasefire does not hold through formal peace talks. Investors who do best stay invested for patterns 1 and 2. Protected by their emergency fund and allocation to survive pattern 3 without being forced to sell. The 14-day ceasefire window creates specific and unusual financial opportunity. Here are 7 moves ranked by urgency. All of them are more valuable in the next 14 days than they will be after the ceasefire either extends or expires. Step 1. Do not make dramatic portfolio changes today based on euphoria. The ceasefire is 2 weeks old. Peace talks have not started yet. The economic damage from 5 weeks of oil shock is still working through the system. Stay your current course. If you are invested, good. If you are underinvested, do not chase the rally today at the exact moment prices jump to 0.5% in a single morning. Step 2. Book all travel plans you have been deferring due to high prices. Gas hit for $1.11 a gallon. Nationally before the ceasefire, airline prices had been surging with fuel costs. With oil falling from $111 to $94, airline tickets are going to get cheaper over the next 2 to 3 weeks. Book travel this week and next while airlines are still using old high fuel cost pricing, but before demand surges back, you get the benefit of declining fuel prices. Step 3. If you have been holding back on any large purchases because of economic uncertainty, the 14-day ceasefire window is a brief stabilization period worth using, not indefinitely. But the window from now until mid-April represents a more stable financial environment than we have had since February. Step 4. Re-enter investments gradually if you sold during the correction. Do not put it all in today. Spread re-entry over 4 to 6 weeks of systematic weekly or monthly purchases. If the ceasefire holds, you still capture significant gains over that period. If it collapses, you only re-entered a portion of your position at higher prices. Step 5. Set up automatic monthly investment contributions if you do not have them. The chaos of the past 5 weeks is the perfect reminder. Automating your investments removes the emotional variable entirely. Set a date, set an amount, automate it. Never think about timing again. Step 6. Watch the peace talks in Islamabad very closely. Formal talks are expected to begin on Friday in Islamabad. The talks carry no guarantee of success. The first credible signals, positive or negative, will move oil prices and therefore markets significantly. Positive signals are the catalyst for the extended rally scenario. Negative signals are the trigger for the relief rally trap. This is the single most important financial news variable. Step 7. Use this brief stability window to finalize your emergency fund if it is not complete. The ceasefire gives you a window of relative calm. 6 months of living expenses in a high-yield savings account currently earning 4% AB. If you are not there yet, this is your window. Get it done in the next 14 days. Oil crashed 16% overnight. The S&P 500 surged to 0.5%. Global markets rallied 5 to 7% in Asia. Airline stocks jumped 10% or more. It is genuinely one of the most significant single-day financial events of 2026. And Warren Buffett, with $350 billion in cash and 70 years of investment experience, is still not buying. Both things tell you something important. The ceasefire is real and the rally is real. And the underlying complexity is also real. The 2-week window, the unresolved peace terms, the infrastructure damage that takes years to repair, the inflation already baked into the system is also real. The right response is not euphoria. It is not panic. It is the 7 steps I gave you, systematic, calm, grounded in data, executed over the next 14 days while the window is open. The people who navigate this moment correctly will look back on April 2026 as a pivotal month for their financial trajectory. Not because they made one brilliant call, but because they stayed disciplined when everything around them was chaotic. Subscribe to The Silent Shift. We cut through the noise every single day and give you what you actually need to know about your money. The shift is quiet, but it is happening right now.